Imagine a fund that pays you a 15% dividend yield and is built on the investing knowledge of one of the greatest investors of all time. And no, it's not me. Sounds too good to be true, right? Well, this brand new ETF is aiming to do exactly that. And in this video, we're going to break it all down for you. And if you're all about high income and Buffett-style fundamentals, then this is a video for you. And be sure to stay to the end where I'll share how I'm using this research in my own portfolio. Let's go. Welcome back, guys. Rico here. So, Buffett-style, see what I did there? Warren Buffett, the Oracle of Omaha, one of the greatest investors of all time, he built Berkshire Hathaway into a powerhouse by sticking to fundamentals, buying great businesses at fair prices and holding them for the long term. He and Charlie Munger built their billions on these fundamentals and ingrained them into the way Berkshire Hathaway does business. Now, imagine an ETF that mirrors Buffett's top holdings and on top of that layers in an income generating option strategy designed to target a 15% annual yield. And that's exactly what this new ETF OMAH is aiming to do. Today, we're going to break it all down, how it works, what it holds, how it's performed so far, and whether it deserves a spot in a high-income portfolio like mine and maybe like yours. So stick around to the end because I'll share if I'm adding it to my portfolio. And as always, this is not investing advice. It's for inspiration and entertainment purposes only. I'm not a financial investor. I'm not your financial investor. Always do your research before investing. So let's do a rundown. What is this fund all about? So keep in mind that I think this is a very interesting play because Warren Buffett was able to double the performance of the S&P 500 during his career. And as of late, that number's gotten closer in the last few years, but this might be a good new play for me since, I love tech so much. This might actually help me diversify further. So I'm doing this all research for you and for me. So talking about the fund objective strategy, there's two parts to this. So one, invest in a portfolio based on the sole active VistaShares Berkshire Select Index, which mirrors the Berkshire Hathaway holdings. And then two, generate income using options of that portfolio. Look at the expense ratio. It's about 0.95, so 0.95%. So it's higher than, say, QQQI or SPYI, but it's typical for actively managed option ETFs like these. I mentioned earlier the distribution target is 15% annually, which is about 1.25% per month. And they state this directly that their goal is to hit that 15% yield annually. And so it mirrors Berkshire Hathaway again, mirrors the top 20 holdings with direct exposure to BRKB itself. So some of the holdings in Berkshire Hathaway, but also in this fund, is Berkshire Hathaway itself, Apple, American Express, Bank of America, VeriSign, Occidental, Chevron, Coca-Cola, Visa, Amazon, a ton. You can see more of them here. And this will help me a lot with adding more diversification to my portfolio. And then some sector exposure. It is heavy in financials, but it's balanced out with staples like IT, energy, and healthcare. So for me, that's good diversification. It's more diversification than I have in most of my portfolio. As you all know, again, I'm mostly in tech with QQQI, AIPI, FEPI, ULTY, things like that. So now that we know how it works, let's look at the statistics and the performance so far. So the current price as of this recording, September 30th, is $19.26. Year-to-date performance just on price is up 4%, but has a total return of 14.73% if you include the distributions. And keep in mind that they launched in March, so this isn't a full year. It's only as of since March of this year. And their dividend yield is 15.1, which means they're targeting their annual distribution amount, and the payout will be about $2.91 per share. And this ETF pays monthly, and most months have been between 0.23 or been around 23 and 25 cents a share. And just to note that 93.7% of the latest distribution was return of capital, which can be good in terms of tax efficiency, but can be bad if the underlying stocks aren't performing well. So just want to keep that in mind. Now, just to get an idea of how this might fit into a portfolio, let's compare OMAH against two big names in the income ETF space. We're going to use two of my favorites and two of the most popular covered call index funds, QQQI and SPYI. So QQQI is the NEOS Nasdaq 100 High Income ETF. The current price as of September 30th is $54.20, and the 6-month total return performance is up 22.05%, which is actually higher than OMAH's, which is at 14.73% since inception. The distribution yield for QQQI is 13.16%, which is lower than OMA. And the annual payout is about $7.37. And then expense ratio is lower. It's 0.68%. And now looking at SPY, which is the NEOS S&P 500 income ETF, its price as of today is $52.30. 6-month performance of total return is 15.29%, and this is more in line with OMA's performance. This touches on what we talked about earlier, how Warren Buffett, as of late, has been tracking much closer to the S&P as opposed to doubling it as he was earlier in his career. And the distribution yield is 10.7%, where OMA has a SPYI beat here. But also keep in mind the total return. And annual payout for SPYI is $5.60, and then expense ratio mirrors QQQI, which is 0.68%. So as you can see, QQQI and SPYI, they have lower costs and stronger price growth this year, but OMA is newer with less track record, but it does offer that unique Buffett-driven base, plus the 15% target yield. So you may be giving up a little bit of price and NAV for the distribution. Comment down below if you'd like me to run another comparison for OMAH. There were others I considered, but since Berkshire is pretty diverse, I decided on QQQI and SPYI. They just made sense to me. So now I want to look at some pros and cons of this fund. So some things that are in its favor. So you're accessing Buffett's blue chip portfolio. It's been amazing. It's performed great so far. You have high monthly income target of 15%, and it's diversified sectors beyond tech, right? So if you're tech heavy like me, this can add more diversification. And then it's professional options management. I get comments all the time about like, oh, can you just write these options on your own? And yes, you could, but it takes time. I don't necessarily want to take time out of my way to do that. And these funds usually have a ton of researchers, a ton of people that are working on it, not just the fund manager. So I don't have those kinds of resources. So will I pay a little bit more in fees to get that? Absolutely. Okay, and some of the cons, yeah, it is on the higher end of the expense ratio, but 0.95% is not out of the realm of what other ETFs like this are charging. It's overweight in financial, so it is 51% in the financial sector. It does have a limited track record, I'd like to talk about. It's brand new. It's only been around since March. And that last month of 93% ROC can be cause for concern. So definitely do your research. Your mileage will vary. Okay, like I always talk about, who's this for, who's this not for? So this could be for you if you are an income investor and you want high monthly income, but not necessarily looking for exponential growth. If you're a fan of Warren Buffett and Berkshire Hathaway and the way they do business and the way they buy companies and stocks, this would be a potentially good ETF to add. And those wanting diversification beyond tech-heavy funds, like this guy here. Who this might not be for are, as always on this channel, growth-first investors. So if you are just looking at pure growth and don't need income, you don't need this. Go for the Qs, VGT, VUG, things like that. Or even just go into like Robinhood or something like that. If you are sensitive to expense ratios, then probably not a good one. If those folks that are sensitive, they probably stay right where JEPQ's at in like the 0.3-ish range. So this might not be for you. And then anyone uncomfortable with option strategies or return of capital, because this is heavy in those strategies. So as for me, where I stand, I'm actually looking to add OMAH as a small position for now. Since it's still a relatively young fund, I want to see a little bit more of a track record. That being said, I jumped into QQQI pretty early, and that's paid off for me, so I'll likely add OMA this week or next. Again, if you follow me, you know that I love tech. QQQI is right in my wheelhouse, but OMA lets me generate income while staying diversified, like Warren Buffett himself. And Buffett always says to focus on business fundamentals, not industry fads. And I think that's a lesson worth applying to investing and to life. Like I always say too, with your investing, stick to your investment fundamentals, whatever you believe. Like for me, total return is the thing I follow most, then distribution yield and other things like that. So stick to your business fundamentals. And just for transparency, I'll share exactly what I do and what this looks like in my November or December portfolio review. So definitely stay tuned for that. So what about you? Now, after that, everything we've talked about, everything I've shown you and the research we've done, what do you think about OMA? Is this something that you'd be adding into your portfolio, or do you need to see more from this fund?